Welcome to The Explainer. So today we're totally tearing down one of the absolute biggest myths in investing. For decades, right? We've all been told that to build true wealth in real estate, you gotta have massive amounts of cash, you need to buy physical land, or you have to take on this crippling mortgage. But what if I told you that you could literally own a piece of premium, multi-million-dollar commercial properties without ever dealing with a broker, without signing a single property deed or, stressing out over a leaky roof? Yep, today we're unpacking exactly how you can invest in real estate through mutual funds using something called a REIT. Let's get into it. Okay, let's dive right in. Here is our roadmap for today's explainer. First, we'll look at the real estate problem, then what exactly a REIT is, check out some massive real Indian examples, do a head-to-head comparison of REITs versus physical property, and wrap up with the risks and final takeaways. All right, starting off with Section 1, the real estate problem. If you've ever looked at the property market, especially as a young professional, you've probably felt completely priced out. It's incredibly frustrating. Let me ask you a question. When you think of real estate investing, do you automatically picture buying a plot of land or maybe a residential flat? We've basically been conditioned to think that real estate equals physical ownership of a single unit. But honestly, it's a completely outdated assumption. And worse, it keeps so many everyday investors totally locked out of the wealth-building game. Because, let's be real, when you look at traditional property buying, this is the massive number staring right back at you. 20 lakhs to well over 1 crore rupees. I mean, that is a gigantic capital barrier just to get your foot in the door. And remember, that's literally just the purchase price. It doesn't even factor in the maintenance headaches, the stress of finding tenants, or the fact that your cash is now locked up in a highly illiquid asset. It's just a huge, heavy commitment. Moving on to Section 2, introducing the REIT solution. So there's actually a totally different way to play the game and smash through those traditional barriers. Enter the REIT, which stands for Real Estate Investment Trust. Think of it exactly like a mutual fund, but instead of pooling your money to buy stocks or bonds, it pools money from thousands of investors to buy and manage real estate. And we aren't talking about tiny apartments here. We're talking about multiple, incredibly premium commercial properties, things like massive office parks, state-of-the-art IT buildings, sprawling business hubs. By investing in a REIT, you're essentially getting fractional ownership of these towering commercial assets that normally, well, only billionaires or massive institutions could ever afford to touch. And here's the best part, what that ownership actually gives you in return. REITs generally offer this fantastic dual benefit. You're looking at a realistic 6 to 7.5% in regular income. That's basically your share of the rent being collected from these big corporate tenants. Plus, just like with physical property, you also get price appreciation as the value of the properties themselves grows over time. So you get the rent plus the growth. It really is a powerhouse wealth builder. Which brings us to Section 3, proof of scale, real Indian examples. Now, it's one thing to talk about all this in theory, right? But let's ground this in some massive, real-world Indian examples so you can see exactly what you'd be buying into. First up, an absolute giant, Embassy Office Parks REIT. This was actually India's very first listed REIT, launching back in 2019. If you've ever been to Bangalore, you definitely know Embassy Tech Village and Manyata. These places are absolute landmarks. This single REIT owns a portfolio of over 50 million square feet. That's staggering. And the tenants paying rent? Over 250 top multinational corporations. Your rental income is literally backed by some of the biggest companies on the planet. And the proof is definitely in the payout. Since listing, they've distributed over 13,800 crore rupees to investors. Next, we have the Mindspace Business Parks REIT. Notice the geographical spread on this one. They own premium office spaces across major tech and business hubs. We're talking Mumbai, Hyderabad, Pune, and Chennai. Altogether, they manage a huge portfolio of over 30 million square feet. And for you, the investor, this generates a really solid, regular income yield hovering around that 7 to 8% mark. It's a brilliant example of how a single REIT expands your property footprint across the entire country without you ever needing to travel or manage a single thing. And lastly, check out the Brookfield India Real Estate Trust. What's crucial here is the backing. It's supported by the global real estate giant Brookfield. They've got a super strong presence in Mumbai, Delhi NCR, and Kolkata, again boasting a massive portfolio of over 30 million square feet. But look at that occupancy rate, roughly 90%. High occupancy from top-tier tenants drives incredibly strong, reliable yields right in that 7 to 9% range. These examples completely cement just how credible and how massively scaled this asset class has become in India.
Let's jump into Section 4, the direct matchup, REITs versus physical property.
Okay, so we know they're massive and we know they pay out, but how does all of this actually compare to just, going out and buying a flat? This direct matchup paints a pretty stark picture. Just look at the investment required. To get into a REIT, you might only need 10 to 15,000 rupees. Compare that to the 20 lakhs or 1 crore plus you'd need for physical property. No contest, right? Then look at liquidity. A REIT is highly liquid. You can easily sell your units on the market whenever you want. Try selling a physical house quickly. Liquidity is terribly low. With a REIT, your income is regular, usually quarterly, whereas physical property depends entirely on finding and keeping a good tenant. And my absolute favorite part, maintenance. With physical property, you're the one fixing the plumbing. With a REIT, none. Zero property headaches. Plus, you get instant diversification across dozens of properties instead of betting your life savings on just one building.
Let's distill this down to a totally relatable everyday scenario. Imagine having to choose between dropping 50 lakhs on a single property or simply investing 10,000 rupees a month into a REIT. That 50 lakh property locks up massive amounts of capital, gives you all the maintenance stress, and ties your entire investment to one specific street corner. But the 10,000 monthly REIT route, it gives you regular rental income, heavily diversified exposure across the biggest tech hubs, and complete liquidity if you ever need your money back. It basically allows the everyday investor to seamlessly enter the multi-million-dollar commercial real estate market. So if you're thinking, okay, how do I actually do this? It's surprisingly simple. Option 1 is a direct REIT investment. If you have a demat account, you can literally just log in and buy REIT units directly on the stock exchange, exactly the same way you'd buy shares of any public company. Option 2 is going through mutual funds. A lot of mutual funds specifically include REIT exposure in their portfolios. Honestly, this is arguably the easiest route for beginners who just want a professional manager to handle all the allocation for them.
Finally, let's cover Section 5, understanding the risks and reality check.
Now, while the accessibility of REITs is completely game-changing, as a smart investor, you need the full picture. Because absolutely no investment is completely risk-free, right? So here are the key risks you need to keep in mind. First is an office demand slowdown. If remote work trends accelerate heavily, companies might just need less office space. And that naturally leads to the second point, vacancy risk. If those top MNC tenants decide to leave, the rental income drops. Third, interest rate impacts. When interest rates rise in the broader economy, REITs can sometimes look a bit less attractive to investors who are chasing higher yields elsewhere, which can impact the unit price. And finally, standard market fluctuations. Because REITs are traded on the stock market, their prices are going to bounce around day to day just like any other equity.
But look, if you want real estate exposure without a massive capital commitment, if you want regular income, and if you want diversification, this is an incredibly powerful tool. So, what is the ultimate takeaway you should leave this explainer with? It's simply this. A REIT equals real estate made simple. You absolutely no longer need to buy land or take on a massive mortgage to call yourself a real estate investor. That is the true beauty of this system.
So, before we wrap up, ask yourself, for your next real estate investment, do you really want to deal with brokers and leaky roofs, or do you just want to open your brokerage app? I know which one I'd pick. Now, please remember, this conversation is for educational purposes only. Mutual fund investments are subject to market risks. Please consult a qualified professional before investing. Keep learning, stay curious, and we'll catch you in the next explainer.